Hey guys, good morning. Welcome to your mortgage rate forecast with Scott Criss, your mortgage rates and news. It is December 21st, and let's get started with the charts. As you can see, bonds have really taken a beating over the last three sessions here. We're currently trading at 102.19 this morning. Support's coming in below us at about 102.17, which we're flirting with, and $102.06. 102.40 and 102.80 up here, if you look at my mouse, is going to be our new resistance level. So we have seen a sell-off. This sell-off is really more than anything due to the tax reform. We did have a mixed bag of news today, which is why we didn't see too significantly different of trading it today, but jobless claims came out. Worse than expected, which was helpful for bonds. Housing numbers are still continuing to show a lot of strength. GDP came out. That was almost neutral, but I'm just going to put it in the red. I'm going to say it really wasn't too bond friendly. So here's what we have. Stocks came in, they're continuing to sell strong today. Again, that's a lot of it is due to the tax reform. They really believe that this is going to be a major help to the economy. And housing statistics on other news came out, increasing from about 6.3% appreciation rate to about a 6.6% appreciation rate. So just basic supply and demand, guys. There's just not a lot of supply of housing, high demand. That's why we're seeing housing go up in value. So hey, good for the homeowners. And one thing to kind of note here, we're being really cautious right now. If bonds break below about $1.85, I should restate that $101.85. This could be actually really bad for bonds. This could push us to some of the worst interest rates that we've seen in over a year. We're currently trading at the worst levels that bonds have seen since March of 2017. So we're just going to keep a really close eye on 101, sorry for the typo, 101.85. That's going to be a really important marker to try to stay above. So to kind of quantify where we're at, November, Freddie Mac released a statement saying that average consumer had a 3.2 rate, paid half a point to get there. Bonds are trading approximately 102.80. So we're about 61 cents worse than what we saw in November. So to help you quantify that, if the average consumer was paying a half a point for that rate, they might be paying closer to a little over a point, point and eighth, to try to get down to that same rate. So that's where things are at there. Now let's get into the forecast. Last projection, I projected 102.80 as the low. on December 14th, it was 102.81. So it was a hit on the last projection, but just barely. Bonds did actually sell at the bottom end of what I was really expecting. And the analysts today are just all over the board, and they have been for quite some time. On the short term, they're very inconsistent. Some think we've already taken our beating, and bonds are going to stay flat for a while. Others are really bearish. They think the bonds could actually sell off even more on the short term over the next 1 to 2 days. As far as long term, they're also inconsistent. They're both bearish and bullish. I am going to take more of a bullish position on the long term and say that if you have a loan and you're trying to close it early in January or in December, I think if it was me, the safest thing I think I would do for myself would just be to lock it in. Lock in the rate. If you weren't able to lock in the rate before all the tax reform news came out and the bonds took this hit over the last three sessions, I almost think the safest thing to do is just lock in now and just kind of, lick your wounds. If you do have the ability to wait until, close your escrow mid-January, late January, if that was me, then I would say then I'd actually probably cautiously float. I'd watch the market. I think the bonds sold off probably as much as they're really going to sell off, and in January I think we could see a little bit more buying of bonds. At the end of the year, we'll also see a lot of people just basically selling off their positions, which will cause for some market decay as well. So final considerations. If you gotta close your escrow soon, consider locking. If you can wait it off until the end of January, mid-January, then float, but float cautiously, okay, guys? So here's where we're at. That's it for now. We'd love to hear from you. Leave your comments down below. Let us know what you think. We are going to be releasing another update regarding the tax reform and how it impacts people that are getting mortgages. So look out for that video. Hey, before you leave, don't forget to hit that thumbs up. And if it's your first time on the channel, you can hit that guy on the left to subscribe. And at the top right, Mortgage Bonds 101. So if this did not make sense to you, it's okay. Click that link at the top right, and it'll give you the basics that you need to know when you're trying to pick the best time to lock in your interest rate. Okay, that's it for now. We'll see you guys later. Have a great Christmas. Okay, take care, guys. Bye-bye.